Hello, good morning everyone. Welcome to Phillip Securities Research Morning Call for 23rd May 2022. We have quite a few stock counter and macro updates for today. Without further ado, I would like to pass on to Jonathan to get started with FAAANGM Monthly. Thank you.
Thanks, Amrish, and good morning, everyone. So we'll start with the FAANGM Monthly for April 2022, and our title is Derating Valuations and Attractive Opportunity. So just going into the performance a little bit, the FAANGM declined 14.9% in April, which was worse than the Nasdaq's drop of 13.4%, while the S&P 500 declined 8.8%. So Netflix continued to underperform, declining 49% in the month. And this was largely due to a negative effect from a contracting user base. Meta, Apple, and Microsoft were the outperformers, declining only about 10%. First quarter earnings for the FAANGM stocks were largely in line with analysts' estimates, with slowing growth as the overall theme for the month. And this was largely led by overhangs from the Russia-Ukraine conflict, weaker macro environment, and a general derating of tech stocks. On the hardware side, short-term headwinds continue to cloud Apple's outlook, with COVID shutdowns and lingering semicon shortages. Higher costs continue to affect Amazon's margins, with decreasing productivity and overcapacity affecting efficiency. Corporate demand for Microsoft's high-end licenses continue, and the increasing popularity of YouTube Shorts as an additional revenue driver for Google is a positive thing. Next slide, please. So we'll just go into the individual news of some of the companies, or rather all of the companies. So for Apple, there were factory shutdowns in China due to COVID-19 lockdowns in Shanghai and its neighboring regions. And these are regions with the highest concentrations of Apple's top suppliers. So these lockdowns basically halted production for several weeks and affected Apple because of its inability to produce the required hardware. There was also a unionization threat from several Apple stores in the US, where organizers have said that what they are really looking for is higher pay, increased tuition reimbursements, larger 401k matches, and other goals. And obviously, the whole threat of unionization would basically put pressures on mainly on wages for Apple. For Apple's second quarter 22 earnings, it was pretty good. However, there were short-term headwinds clouding its outlook. Third quarter 2022 revenue growth should be impacted by about $4 to $8 billion due to the COVID shutdowns in China. Also, lingering semicon shortages are affecting supply and demand, or rather production and demand. Moving on to Amazon. Amazon is actually appealing against unionization. So they actually have plans to appeal its loss to union organizers in New York, claiming that the NLRB, which is the National Labor Relations Board, suppressed voter turnout by how it set up its voting period, causing long wait lines, and also by threatening employees to vote in favor of the union. It's also under regulatory investigation by the SEC, and this is predominantly as to how Amazon uses its third-party seller data for its own private label business. So it's like reusing third-party data. First quarter 22 results for Amazon were weaker than expected due to lingering cost pressures. Revenue guidance was also weak, with a priority for Amazon now to reduce costs in overstaffing and overcapacity, while trying to pass on some inflationary costs to its sellers. So for Microsoft, there wasn't much news, but their third quarter 2022 earnings was outperformed, and it was another strong quarter for them. Revenue and margins beat across all segments. And the fourth quarter 2022 was guided to be another strong quarter for them to round off their year. Reopening of the economy should drive office commercial growth from small and medium businesses, while cybersecurity needs should drive ARPU growth through upgrades into their premium E5 licenses. So you expect Microsoft Azure to continue to benefit from the businesses' shifts to the cloud. Next slide, please. So for Meta, they began testing a new monetization tools for the metaverse, where they selected a group of creators and allowed them to sell virtual items in Horizon Worlds, which is their metaverse created by Meta and Verizon. And creators would be rewarded for building worlds that attract the highest amount of users spent or user time spent in them. They also opened their first retail store globally on the 9th of May 2022 on its campus in California. And this store is expected to give users a chance to physically test out some of their hardware products, like the Quest 2 VR headset and the Ray-Ban smart sunglasses. So Meta's first quarter earnings were a mixed bag with EPS beating estimates on lower than expected expenses. However, the outlook for the second quarter remains weak, with headwinds from Apple's ATT changes, strengthening US dollar, and loss of advertising revenue from its ban in Russia expected to continue. So for Netflix, Netflix is actually in talks with the NFL for a collaboration. The NFL is the National Football League, and they're planning to collaborate on a docuseries type production, which is similar to its other sport-oriented programs, Formula One, Drive to Survive, and The Last Dance. So if this is successful, it could be another huge content addition to Netflix, and could be a catalyst for increased subscriptions. So overall, their earnings calls was fairly poor, with only EPS beating estimates. And the stock price was driven down significantly by slowing revenue growth and a quarter of negative subscribers additions. Moving on to Alphabet. Alphabet actually pledged to invest $9.5 billion into more US offices and data centers, which is an increase of about $2.5 billion year on year. This investment is expected to create at least 12,000 new full-time jobs, with the focus on building up new data centers in the US states of Nevada, Nebraska, and Virginia. So their earnings met expectations on top line, but missed on earnings, and this was led by an almost $6 billion swing on unrealized loss of equity investments. Revenue growth is back to its pre-pandemic levels, with growth drivers cloud and YouTube continuing to increase at a rapid pace. Next slide, please. So we remain overweight on the FAANGM. Our preferred stocks are still Google and Microsoft, because we expect Google to continue benefiting from digital advertising tailwinds and increasing corporate demand for cloud. We expect a continued strong corporate demand for Microsoft's higher-end licenses to continue, especially amidst increasing cybersecurity worries. So that's it for the FAANGM Monthly. I'll now go on to C Limited's first quarter earnings, with the title of Improving Unit Economics. So for their results, the first quarter revenue net loss was at 21% and 30% of our forecast. C posted $2.9 billion in revenue, which was a 38% year-on-year growth. It posted a $600 million net loss and 80 cents for their loss per share. If you look at the table on the left, e-commerce, which is their main revenue driver, grew 62.6%, with gross profit improving 81.3%. On the revenues, like I mentioned earlier, their first quarter 22 revenue was in line with our forecast, and also beat consensus estimates by about 5%. And this was mainly driven by growth in Shopee and C-Money. So Shopee grew 64% and C-Money grew 360% year-on-year. The next positive is that Shopee is actually growing closer to profitability in some of its mature markets. The segment saw year-on-year improvements in gross profit margins and is on track to achieve a positive adjusted EBITDA before HQ costs. So Shopee also remained the top-ranked shopping app on the Google Play Store globally. For the last positive, we're seeing rapid growth in C-Money due to increased adoption of digital payments, especially in Southeast Asia. So C-Money grew 360% year-on-year, and it was supported by an increase in quarterly paying users, QPU, which was up 78%, and total payment volume, TPV, which was up 49% year-on-year. On the negative side, C actually reduced Shopee's full year FY22 revenue guidance to 8.5 to 9.1 billion US dollars. So they actually just moved down their bottom end guidance from 8.9 to 8.5 billion. And the main reason for this is due to a more uncertain macroeconomic environment for some of its markets, or rather for most of its markets moving forward. So if you take the midpoint of this revenue guidance, it's essentially a 72% year-on-year increase for the company. On the outlook, we expect a continued weak macroeconomic environment to affect growth. We also expect digital entertainment, which is Garena, to continue battling headwinds in India, where its top self-developed game Free Fire was banned. We expect e-commerce growth to continue declining due to, and this is mainly due to a maturation in a lot of its markets, but it's still growing pretty healthily at about 60+%. And we expect continued growth in digital financial services, which is C-Money. This is mainly driven by increased adoption of digital payments across the region. We maintain a buy rating with a lower target price of $150 from $196. And this is mainly because we reduced the terminal growth rate from 4% to 3% due to a weaker macro outlook. So that's all for C Limited. I'll pass my time now on to Natalie.
Thanks, John. Good morning, everyone. Okay, so I'll start off with CapitaLand Investments first quarter 2022 update. So just right off the bat, the revenue, the first quarter revenue was in line, forming 25% of our forecast. We'll start off with the table on the left-hand side. So revenue grew by 23%, and revenue is split into two categories. First of all, real estate investment, which is the investment property held on the books. So that grew by 28%. This was driven by recovery in operations. And the second component of revenue is the fee-related earnings. And there are four parts to this. So first of all, the REIT management. So REIT management revenue actually fell by 5%. And then PE fund management that grew by 127%. Property management that fell marginally 4%, as well as lodging management, which grew by 31%. So onto the positives, fund management fee-related earnings that grew by 28% in total. That means comprising REIT and PE funds, and that formed 20% of the revenue. So on the PE side, what actually drove this 120% year-on-year increase was the transaction-driven fees, meaning acquisition-related or divestment-related, or that kind of fees. So that grew by almost 5 times year-on-year. As well as the recurring revenue, which grew by 21%. Okay, so just some examples of what contributed to these fee-related earnings. So CapitaLand actually unwinded one of their PE funds, which is CapitaLand Vietnam Commercial Value Add Fund. So that was unwound in January, and they managed to realize IRRs above 200%. Another fund that was also unwound was already not unwound, but rather CLI reduced its equity stake. That was Athena, and they managed to realize about 60 IRR 60% above the project IRR. Yeah, so that was part of the reason why fee transaction-driven fees were so high. On the REIT management front, transaction revenue actually fell by 48%. This is in comparison to first quarter of 2021, where when we exited the pandemic year, the REITs were very active, trying to acquire and grow their portfolio after a lull year. So comparatively, the revenue from transaction-driven REIT income was down by about 48%. However, recurring income did grow by about 13%. The second positive would be the 31% growth in lodging management fees. So that was on the back of recovery in operations. RevPAR grew by 34% year-on-year. This was partly due to a 14% increase in average daily rates, ADR, as well as portfolio occupancy, which increased from 48% to 57%. Not to mention, over the course of 2021, 8,200 units turned operational, means they started operating, as well as in the first quarter, an additional 2,200 units turned operational. So that, of course, will contribute to fee income. Okay. Another thing probably worth mentioning is that the strongest markets for the recovery in lodging management fees is Europe and Singapore. So RevPAR in Europe grew by 168%, and in Singapore it grew by 40%. Okay. The last positive would be the real estate investment business. So that grew by 28%. As I mentioned earlier, it was due to recovery in operations across their various asset types. On the negative front, macroeconomic and geopolitical headwinds are slowing fund generation and acquisition momentum. So this generally risk-off environment has resulted in higher required rates of return for capital investors, and that also limits the eligible assets to seed the PE funds. Not to mention the lockdown in Shanghai, as well as the tightened restriction in Beijing. If it continues to prolong or persist, that might actually delay planned transactions, as the ground team in China is unable to meet with investors and proceed with the initiation of PE funds. In terms of outlook, we expect the real estate investment and the lodging management business to continue to recover. However, the CLI's 10% FUM growth target may be at risk given the current macroeconomic and geopolitical headwinds. Overall, we maintain our accumulate recommendation. Our sum of the parts target price is raised from $4.05 to $4.12 as we raise our fund management margins. So that, of course, led to a higher pattern. Now moving on to the next counter, which is Manulife US REIT. Okay, so this is Manulife's first quarter 2022 operational update. So there are no financials that were provided in this operational update. Starting off with the table on the left-hand side, this is the leasing highlights. So you can see that the first quarter of 2022 was actually a comparatively weaker leasing quarter, and only 1.3% of the portfolio NLA was signed. Reversions, however, were relatively good, coming in at positive 3.9%, compared to the full year reversions for FY21 of negative 0.8%. Okay. Overall, new leases formed 54% of the leases signed, and this was a softer leasing quarter because the first half of 2021 was impacted by the Omicron wave. However, the management did comment that physical tours picked up towards the end of the first quarter, so ending the first quarter 13% higher year-on-year. In terms of the negatives, portfolio occupancy slipped by 0.6 percentage points from 92.3% to 91.7%, and there were 5 assets that actually contributed to this lower portfolio occupancy, or rather portfolio occupancy decline. So they are Exchange, Peachtree, Figura, Centrepoint, as well as Capital. And there was some notable downsizing within the portfolio. So one of it was downsizing by a legal tenant at Peachtree, as well as another tenant in the information sector at Exchange. So both these tenants occupy about 20,000 square feet of space each, and these are considered large tenants. Okay. So just to provide some, just a note on these downsizing. So these 2 spaces, they're actually under rented, meaning that their in-place rents are actually below the market rents. So meaning that there could be positive rental reversion potential if the leases are renewed, or rather released to new tenants at market rates. And in terms of, just to provide some color, so 80% of the NLA signed over the last 15 months, they were renewals, and out of these 80%, 54% of the renewals, or rather tenants renewing, maintain their existing space requirement, meaning that they did not downsize. And on average, those tenants who downsize, on a portfolio average, they reduce their space requirements by about 27%. So in terms of outlook, the projected the US office market continues to improve. So the projected 12-month rental growth in Manulife's markets improved to 3.8% as of April 2022 compared to 2.3% in January. And of course, occupancy, improving occupancy remains a key focus for Manulife. And under the guidanship of their new CEO, which is Grant. He has highlighted several strategies in which he intends to go about improving the occupancy, and they are, they include building spec suites or speculative suites, meaning that they fit out the vacancies in advance, as well as leasing to co-working operators, offering more flexible leases, increasing touring, as well as offering higher commission to leasing agents. So, hopefully the combination of these strategies will help to raise Manulife's occupancy. We maintain our buy rating for Manulife, no change in our estimates, and the catalyst for Manulife includes stronger than expected leasing as well as portfolio reconstitution, as we know that Manulife is still trying to increase its proportion of tech tenants and health life science tenants. Okay, next slide, please. Now we're talking about Prime US REIT's first quarter 2022 update. Distributable income was in line, forming 25% of our FY22 estimate. And just starting off with the table on the left-hand side, we see that gross revenue grew by about 13.6%. This was due to contribution from the acquisition of Sorrento Towers as well as One Town Centre, and both these assets were acquired in July of 2021. Not to mention, car park income also grew by 30% year-on-year as more tenants returned back to the office. Property income grew by 10.4%, a slower rate due to some higher vacancies within the portfolio. In terms of distributable income, that was up by 19% because Prime was recognizing termination fee recognized from WeWork as well as another tenant at One Washingtonian Centre. In terms of positives, the leases signed in the first quarter jumped by 80% quarter on quarter. So 172,000 square feet was signed at 3.4% positive reversions. Of course, this number is lower than the 9.8% reversions that we saw in the fourth quarter of 2021. And this is primarily due to some of the backfilling done at spaces which were vacant for more than 12 months. So if the space is vacant for more than 12 months, the new leases signed, there will not be any reversions calculated on those spaces. Yeah. So that partly explains why the reversion for the first quarter was lower. Okay. Overall, the manager is seeing a stronger leasing demand as well as a deeper tenant interest list, meaning that they're seeing more tenants across a wider array of industries. Just to provide some color, post-quarter, the manager signed about 46,000 more leases and bringing the year-to-date reversions up to 6%. In terms of negatives, portfolio occupancy dipped quarter on quarter from 90.3% to 89.9%, despite some backfilling. So the two assets where there were noticeable backfilling was Crosspoint and 222 Main, where occupancy increased by 5.4 percentage points and 3.7 percentage points respectively. And out of Prime's 14 assets, 5 assets have occupancies below 90% and require more significant backfilling. That being said, Prime is still recognizing pre-termination income from WeWork, which terminated their lease in the third quarter of 2021. And they will receive this pre-termination income all the way until early fourth quarter 2022, as well as another tenant that left the One Washingtonian Centre building, where Prime will continue to recognize this pre-termination income until the third quarter of 2022. So that being said, if Prime is able to lease out this space before the rental pre-termination income falls off, that means that they are basically they've basically been more efficient with the leasing, and and there's upside for them. In terms of outlook, leasing activity picked up in the first quarter of 2022. As mentioned, the manager has noted broader tenant lists and interest coming from small, medium, as well as large space users across more industries. The expiring rents in the portfolio, they are about 6% below asking rents, meaning that we could expect more positive rental reversions for the leases that will be signed in the year. Overall, we upgrade our recommendation from accumulate to buy, and we raise our target price from 94 US cents to $1. And this is because we roll forward our forecast. Prime is our top pick in the sector due to its greater exposure to STEM and TAMI sectors, which are the sectors that are experiencing secular growth. Okay, that's all for me. I'll now hand the time over to Terence.
Thanks, Natalie. For BRC Asia reported first half 22 results that surpassed our expectations. In terms of the first half financial year 22 summary, revenue and net profit rose 61% and 107% year-on-year, respectively. If you look at the table on your left-hand side, you can see the revenue increase on a 61% year-on-year increase was driven by a combination of ASP and volume increases as the construction sector continues to recover. On the back of its strong set of half-year results, the group also declared an interim dividend of 6 Singapore cents per share, which is 2 cents higher than for the same period last year, signaling the management's confidence in the near-term outlook of the group. In our next slide, in terms of the positives, first half financial year 22 revenue and net profit was ahead of our expectations at 81% and 83% of our full year 22 earnings estimates. The beat came from a faster than expected recovery of the construction sector. They did not provide the volume move, but we estimate that the volume move during the period rose 30% on a year-on-year basis in the first half of financial year 22. In the first half, they also recorded a debt reversal of 1.8 million for onerous contracts that because of the increase in contracts delivered. Last but not least, the credit situation remains stable. Provision for impairment loss on trade receivables fell over 60% on a year-on-year basis in the second quarter of financial year 22. This was aided by the recovery of the construction sector and by government support. In terms of the negatives, the net gearing surged in the first half of 2022 because of higher steel prices, but this is actually within our expectations, and we really factored this higher gearing mainly because of the higher steel rebar prices. In our last slide, in terms of the outlook, the construction sector saw a faster pace of recovery in the first quarter of 2022. We expect escalation of activity to continue for the rest of 2022. The order book for BRC Asia remains healthy and above $1 billion. HDB has also announced a significant increase of 35% of HDB flats to be launched for the next 2 years because of rising demand for housing. Transport Minister S. Iswaran also announced that Changi Airport's Terminal 5 will also commence construction in the next 2 years. On the back of this, we maintain our buy recommendation with a higher target price of $2.26. Financial year 22 earnings was upgraded by 37% to account for the faster pace of recovery in the sector. Our valuations is based on 8 times FY22 PE, which is a 15% discount to its 10-year historical average PE because of the still quite uncertain environment in the construction sector. First half 22 dividends jumped 50% year on year to 6 cents. One of the things we want to highlight is the stock is now trading at 10.7% FY22 dividend yield. That's all for me for BRC Asia. I'll now hand over the time to Vivian.
Thanks, Terence, and good morning, everyone. So for me, I'll be starting off with LHN's first half 22 results with the report titled Maintaining Strong Occupancy Levels. We'll be seeing that later on. So a brief overview first. After the listing of the logistics arm, LHN is now a real estate services provider. On the left part of the slide, you have the industrial, residential, and commercial properties, and also facilities management. So under industrial properties, they have the work plus store outlets. Under residential, they provide the co-living spaces under the Collywood brand, and this too would be the main drivers of growth for the company for the next 2 years. So moving on to the next slide. Yeah, thank you. Firstly, on the results. So first half 22 revenue and adjusted PATMI were at 46% and 55% of our forecasts respectively. Reason why we take adjusted PATMI here, if you refer to the table on at the left-hand side, at the bottom there is a note saying that The adjusted PATMI is calculated based on PATMI after removing the share of results of joint ventures and also fair value gain on investment properties, which are the one-off items. So moving back to the top of the table, you can see that the revenue was down 8% year on year. This is mainly due to revenue from facilities management dropping about 20%. This is mainly due to lower demand for dormitory management services and supported by the increase in revenue from the co-living segment, as highlighted in the red box, about 40% year-on-year increase. So moving down, you see profit before tax jumping almost twice the times of the first half 21 figure due to the fair value gain on investment properties. But on adjusted PATMI, as mentioned, it was down about 7%. Dividends per share remained the same. So moving on to the positives on the right, Koliwu is the main driver of revenue and profit growth, as can be seen. First half 22 record revenue of $7 million is due to two main reasons. Firstly, full half-yearly revenue recognized from this 1557 Keppel Road property launched in the 4Q of FY20. And then you have in the first half of 22, there were two other properties at 320 Balestier and a joint venture property at Amber Road, which commenced operations. And the surge in profit is due to the fair value gain on investment properties and on the joint venture investment properties, totaling about $20 million. Moving on to the negatives, however, we do see lower revenue from commercial properties and facilities management. Commercial properties' lower revenue is due to the disposal of loss-making properties, which is also why actually you see the profit surging. And on facilities management, as mentioned, lower demand for this dormitory management services during the height of the COVID pandemic. On the occupancy rates, however, you do see industrial occupancy rates at 95%. Work plus store is almost full at 98%. And for co-living is at about 96%. The second negative, they recorded a higher net debt of about 98 million. This is due to long-term bank borrowings increasing 28%, mainly used to finance the acquisition of this new industrial property that they acquired at 55 Tuas South, renovation costs, and also working capital for the co-living business. So moving on to the next slide. More updates include the aggressively expanding Koliwu portfolio. The picture on the left is an example of a Koliwu room in the new property at Amber Road. So as mentioned, first half 22, they launched 2 new properties. For the second half of FY22, there are 4 additional residential properties that we expect to commence operations. So for the full year, we are expecting the number of keys to increase by 250, which implies a 30% year-on-year growth. And for FY23, the major project would be the new property at Mount Elizabeth, which would add about 411 keys. And for the full year of FY23, we're expecting a 50% increase. So from FY21 to 23, we are expecting the total number of keys to actually double from about 800 to around 1,600. For industrial properties, the demand remains strong. For the Work Plus store, they are mainly catering to the e-commerce business owners. So the demand remains strong as we see online retail sales proportion still very elevated at an average of 16% in the first quarter of the year. Pre-COVID was around 6%. And occupancy rates for their industrial properties inched up about 2 percentage points to 95.4%. So we maintain a buy with a higher target price of 51 cents from 49 cents. Our FY22 forecasts remain largely unchanged, but on the valuation, there has been a minor change. So the valuation for all business segments except for LHN Logistics, which is now listed, is pegged to 6.5 times FY22 PE. And for the logistics business, we add 11 cents from the market value of the listed subsidiary, taking a 20% discount to account for any volatility in the share price, which gives us 51 cents. So the growth drivers for the second half of the year and FY23 would be the new Koliwu properties and also revenue recognition from the industrial property which they acquired at Tuas. And just to emphasize, The LHN, the company, is currently trading at about 3 times PE and at a dividend yield about 4.4% for FY22. Yep, so that's all for LHN. I'll be moving on to a Phillip on the ground for UMS. So next slide, please. We do not have coverage on UMS. This is just a summary of their first Q22 results. So for UMS, they do front-end equipment assembly, and they also manufacture semiconductor and aerospace components. On first Q22 results, you can see revenue surging about 71%. Profit before tax surging about 50%, but on the PATMI line, it was only up 26%, and this is mainly due to the high tax expenses. So similar issue as the previous quarter, that they did not meet the local workers' employment criteria, but it has since been fulfilled, and the company is still in ongoing discussions with the Malaysian authorities to resolve these tax issues. For the JEP subsidiary, they do outsource some semicon components to JEP. And for JEP, which is also doing like aerospace components manufacturing, they did mention that the aviation recovery is probably only meaningful in 2023 or even 2024. And for the new factory, it's still on track to be completed by the end of the year. Capacity-wise, it's expected to ramp up about 60% from the size of the factory. So on the costs, aluminium remains bulk of their material, and mentioned that they can pass on some, but not all. And lastly, for labor, it's still a challenge, like a war, to hire workers in Penang, but they are also continuing with their plans to hire more workers in Malaysia. For the outlook, the main customer just released the second quarter earnings and also 3Q guidance a few days back. So they did mention that they were constrained by supply chain challenges, with second Q revenue actually below the guidance. And for 3Q, we can see that the guidance wise is expected to be only up about 1%. But on a first half basis, we can see it's up about 20%. If you factor in the 3Q 9-month wise, it's around 13% increase. So still reasonable to say that we can expect UMS to grow at least 20% year on year. And the other good news for UMS is for the new Penang plant, they're updated that the discussions with customers is in advanced stages. So you can expect more good news from them soon. So that's all for UMS. Moving on to my last counter, which is Sunpower, again a Phillip on the ground. And we did release a non-rated note for their first Q22 results. So for Sunpower, they are a provider of industrial steam. They sell clean electricity to the state grid, and they also provide clean heating to residential households. As of first quarter, they have 10 plants in operation, 1 under construction, expected to start operations in 2022. For first Q22 results, revenue was up about 77%, recurring revenue up about 50%, mainly attributed to the surge in the steam sales volume near record level and also higher steam prices. So for the steam prices, they raised prices at the end of last year, as you can see, to pass on the higher costs when the coal prices surged almost 5 times. But they actually adjusted it downward when the coal prices stabilized in the December of last year. But this is according to management. But Ukraine crisis actually caused the coal prices to fluctuate again. So it's impacting. We can expect possible impacts to their margins again. So the margins are still not fully recovered. As you can see on a year-on-year basis, it's still down about 5 percentage points. And they mentioned that another reason is due to this segment, which is supplying heat to residents, is still facing a loss. Another reason for this is that the prices is more regulated by the government. So there's a longer time lag in passing on the higher feedstock costs. And they're also in the midst of applying for grants from the government. And for first Q, they also recorded a negative operating cash flow due to higher trade receivables. And management mentioned that it was due to the COVID situation in China. So they actually extended some of the payment timeline to receive the payments from their customers. And on the COVID lockdowns, it was only updated that some of the customers' operations were affected, but they have been seeing some recovery. Lastly, on the outlook, one project commenced commercial production. We are expecting a launch of another phase 2 for Shantou project in 2022, and the one plant under construction, which is in Shanxi Xinjiang, is expected to start operations this year also. So that's all for Sunpower. I'll now be passing the time on to Sean.
Thanks, Vivian. So the Astro private equity bonds are back once again this year, with the latest being the 7th issuance of the Astro series. For those who have never heard of the Astro bonds, they are different from the usual corporate bonds, which the coupon and principal payments are supported by the cash generated from the businesses of the bond issuer. While for Astro bonds, these bonds are issued to finance the purchase of a portfolio of PE funds. Within the portfolio of PE funds, there are hundreds of underlying companies, and when these companies are sold, the cash generated will then be able to use to pay the coupons and the principal. Similar to previous years, Astro bonds offer different tranches of bonds to their investors. For the breakdown, if you shift your focus to the bottom of the screen, there are a total of 3 classes of bonds, namely Class A1, A2, and B, where Class A1 is denominated in Sing dollars, and A2 and B are denominated in the US dollars. Only Class A1s and B will be available for the retail investors. This year will be the very first time ever that Class B bonds are being offered to the retail investors. For Class A1, they have a total issue size of 526 million, of which 280 million is dedicated to the retail tranche, and Class B have a total issue size of 200 US million, and 100 million will be available for the retail investors as well. For Class A bonds, they have a mandatory call date of 5 years, while for Class B bonds, they have a mandatory call date of 6 years. If the bonds are not redeemed on the scheduled call date, there will be a one-time step-up interest rate of 1%. All bonds have a maturity date of 10 years. Astro 7 possesses multiple structural safeguards for their investors, and such examples include a mandatory reserve account for both Class A and B bonds. These reserves accounts are set in place to ensure the cash flows from the funds are being held for redemption purpose at their scheduled call dates. Additionally, Astro 7 has also included a credit facility provided by DBS, which the issuer will be able to utilize to cover the bond interest, certain expenses and fees in the event of a cash shortfall. Some notable dates for the retail investors would be for the retail tranche for Class A1 and B is already open for application, and it will close on the 25th of May 2022 at 12 p.m. On 30th May 2022, it will be available for trading on the secondary market. Moving on to the repayment for the bondholders, Astro private equity bonds follow a cash flow waterfall structure, also known as the priority of payment features, which can be seen on the next slide. Thank you. So on the left-hand side, we are able to see the waterfall structure where the cash flow generated from the 38 PE funds, where the cash flow generated from the 38 funds will be distributed to Astro 7 Private Limited, who is the issuer of Astro 7 bonds. The cash would then be used to pay off expenses, interest to the bondholders, making payments to the reserves account, and principal repayments before the sponsor can receive any cash as equity shareholders. For Class A1 and A2, they are ranked pari passu, and Class B bonds are ranked junior and will be paid after Class A1 and 2 in terms of the priority of payments. The sponsor who are ranked below the bondholders in terms of repayment for Astro 7 is the sole shareholder of the issuer and the sole owner of the equity investment. Hence, there is a strong alignment of interest with their bondholders. Last but not least, for those who are interested to find out more about Astro 7, do scan the QR code on the right to register, as we'll be holding a webinar right after this at 1:30 with the Azalea management to dive deeper into this issuance. With that, I would like to hand over the time to Paul to talk more about ComfortDelGro.
Thanks, Sean. So I'll move on to ComfortDelGro's first quarter update. Update means they don't really give a full set of results. So for the results, the revenue was a bit flattish. So the results were within expectations. And excluding the disposal gain and government relief, we estimate that the profit was up almost 66%. What was the positive was public transport. So public transport refers to bus and also train. One of it was also due to fuel indexation and bus chartering revenue. So the revenue was up about 6%, but operating margins jumped significantly. If you exclude the relief and gains, it's up almost 83%. What was weak, which is down, which was weaker, which was down by the revenue was down by 11%, was taxi. So one of the reasons taxi revenue is down is because of the rental rebates, about around 15%. So for every $100, they actually give back $15 to the taxi drivers. Another reason is also the lower taxi fee, about 7% year on year. But what we think is that taxi currently has a competitive edge, I think, over private hire vehicles because of the higher percentage of hybrid vehicles, which is of course more fuel competitive. And if you are on the Comfort taxi fleet, you will get like a 15-20% discount on your, which is 15-20% cheaper fuel than anyone gets in the retail market, and that is even after your credit card rebates, which I actually double checked. So in terms of the outlook, the rebate will continue. We initially expected the rebates to be removed because of the reopening, but they will continue until September. However, effective this month, they're going to impose a 4% booking fee. So it used to be zero if anyone, I think Grab charges 20%, Gojek 10%. So for ComfortDelGro, they'll charge 4%. And one of the reasons is, without stating the obvious, they realize that most passengers want their cars, everybody books a car before nobody waits for taxis these days. So that is the trend. And they're preparing for that by having this app and trying to push more drivers to use the app, and rather than what they call it, when you wait for a taxi or you wait for a taxi at the station, at the taxi stop. Sorry. So this is quite important. This can be could be a huge upside. I mean, if the app really takes off. So in a way, although the rebates are still there, this will effectively kind of reduce the rebates. Back of envelope, maybe you will add another 5 to even 10% to their taxi rental, assuming, depending on how much the collections or how many bookings are through there. But this is just an estimate because they don't give details yet. But this could be a big driver to the stock. I mean, if this app really takes off. The other thing, the negative is the pandemic in Beijing. So that as a result of that, the lockdowns, they are still giving rental waivers for taxi drivers there. In terms of some of the interesting capex that they are working on, will be everything EV, EV bus, EV taxis. They're also building a lot of EV charging stations. Although they're not given the financial metrics how this will work, but they've got quite an aggressive plan to roll out EV charging stations. So we maintain our buy and our target price. For us, although revenue was only up 4%, most of the 40% of the revenue flowed to earnings. So you get a big 60% jump in earnings, although revenue was only up 4%. Because of the huge operating leverage, this is all fixed costs. The rail and taxis, they're all fixed costs. So there's no change in our forecast or target price. We just expect stronger quarters, stronger performance in the coming quarters as the opening of borders, removal of social restrictions, and so forth. Next slide. Asian Pay TV, next slide. So the highlight for us was basically the broadband growth. So in terms of the results was within expectations. They continue to pay 0.25 cents distribution per quarter. The highlight was broadband. You can see a table on the left. Broadband was up almost 17%. One of the reasons is that you're getting more subscribers and you're getting higher ARPU, higher selling price, which is rare. I mean, volume and price up, but that's because a lot of people are transitioning more into the higher 300 megabits to 1 gig plan, and also they're working closer to the mobile operators in Taiwan to sell their broadband. The negative is the non-subscription. Inside the basic cable TV, you can't really see. They actually do rental for home shopping networks. Of course, this is not the most popular form of entertainment now, especially now that everyone's moving to online shopping. But they had a boost during the pandemic, so you're going to see this start to wind down, and that's why there's a decline in revenue. In terms of outlook, our focus, revenue and earnings and cash flows are stable, but our focus has been on the debt and the impact of higher interest rates. So they have about 1.5 billion debt. 1 billion has already been hedged out to fixed rates for up to 2025. So we don't think, even if we assume a 100 basis point rise in interest rates, the impact will not affect the cash flows to pay the dividends. So the cash flows is about 80 million a year, less off the dividends about 18. So there's enough buffer to continue to pay this 7.5% dividend yield. So no change in our forecast or on our target price. Next slide. So Propnex. So Propnex results was beating expectations, although it is higher than a 25, because if you every quarter should be around 25, it's still higher than that, because we are expecting a deeper decline in the following quarters. Again, the highlight of this, the strength of this company is the operating cash flows, because it's very asset light. The negative is the new launch. So new launch was down. It's under project marketing, they call it. It's down 5%. There were only 172 units launched in the whole of first quarter, because inventories by the developers is very thin. So you're talking about decade low of unsold inventory. They expect about 6,000 units, only 6,000 units to be launched this year. So a lot of the sales will have to come from launches that happened in 2021. And in the typical year, we got 10,000 units. So it's going to be a weak year for new launches. The reason why you see the private resale doing well, 22%, sorry, sidetrack a bit, but it's because some of it is prior quarter sales. So in terms of the outlook, we are looking at almost 30% decline in earnings for this year. And the volumes are going to be weak until the year and for the next 3 quarters. And these are their forecasts, not even ours. So property resale volumes are supposed to be down almost 20%. Resale is supposed to be down 20-25. New home sales as much as 30%. HDB will also decline at a slower pace, maybe 5-10. But offsetting for Propnex, the focus is market share gains, because they continue to grab a higher proportion of real estate agents. I think now the real estate agents is almost 12,000 agents under them. And of course, higher prices is also will help on their revenue. And they're also working on some en bloc transactions, which I think probably each one might maybe 1 to 3 million. So they're working on 2. So this will help in at least buffering some of the weakness. So this is a new form of revenue for them, working on en bloc transactions. We maintain a neutral. What will help this stock, I guess, in the meantime, is just their 5% dividend yield, which will be well supported by their 160 million of cash. Okay, next. So for Thai Beverage, the earnings actually beat our expectations for the first half. The dividends was unchanged. So what beat our expectations was actually beer. So you look at operating profit line, the table on the left, you can see that beer almost up 80%. So one of the reasons that's helping their beer business is, of course, volume rebound, but that's because last year there were lockdowns and so forth. So that's only natural. But the other thing that surprised us was the higher prices. So they actually increased price. They don't give the exact number, and it's sometimes hard to compute too, but they said about low single digit to high single digit. And this will have been, they raised it some in December, some in April. So second quarter will definitely enjoy some of these higher prices. Although the volume rebound, but it's still almost 1 quarter below pre-pandemic. The other thing that helped the results was, again, throughout the pandemic, they've been very good in controlling costs, and it continues even to this first half. So if you look at their operating expense, it fell 2.6%. Considering, you can see from the table on the left, the total revenue is up 10. So they're controlling their admin costs really well, actually cutting admin costs even though the revenue is up. Yeah. So in terms of negative spirit, just to refresh, for Thai Beverage, the main revenue comes on spirits. So that is almost 75% of profits. So the spirit volume grew, but what happened was they raised price, but a lot of there was a bit of front loading, because before you raise price, a lot of the distributors will just stock up before your price increase. I guess everybody knows about it. So a lot of them stocked up on their higher volume, low price items. So that's why the revenue is a bit weaker. But anyway, just to move on to the outlook, the key thing in terms of how fast the recovery will happen will be sadly, the reopening of the entertainment outlets, which is still closed, very sad, of course, in Thailand. So that will determine the pace of the recovery. And of course, if a complete reopening, that will help their beer and also their brown spirits. So we expect earnings recovery for this year. We maintain our accumulate, but we raise our target price to 80 cents because as we raise our earnings forecast by 5%. Next slide. Q&M Dental, next slide. So for Q&M, the earnings was within expectations, and if you remove the disposal gains and only on the dental earnings, it probably grew about 27%. If you look on the table on the left, the headline number is down 31 because there was a big gain, 4.4 million gain. You can see the table on the left. In terms of the positives, although there were fewer clinics this quarter, but it was up 17% year on year. So this has been the thing that's been helping drive revenue and earnings. So the total number of clinics in Singapore rose 17% to so they got like 99 clinics in Singapore now, and I think more than 200 dentists, and I think more than 50 specialists. I mean, sorry, inside the 200 is more than 50 specialists. The reason we always focus on Singapore clinics, although they have Malaysia, because I think 80-90% of profits all come from Singapore. So they still maintain their guidance of 30 new dental clinics. They've opened 5 this year, but they already identified another 10. The negative is the one that is going to drag earnings continues to be the Acumen, the COVID-19 PCR test. So just to give you a flavor, quarter on quarter, they used to earn 3 million. Now it's only 0.7 million. So the weakness contribution from it will continue to wind down, because the only use of PCR now, COVID-19 PCR, is for selected countries that need it. So the focus for Acumen now is for sepsis and also cancer marking using a PCR test. So in the near term, there will still be a bit of a headwind in terms of dental admissions to clinics, I mean, across Singapore, because once borders open, there might be fewer dentists, and then there will be fewer people within Singapore. So that can have some impact on volumes. But for the key for them will be new dental clinics. So just as a side note, apart from opening more clinics, of course you make more revenue, but it's also a very important referral system. So a lot of specialists like to join their dental chain because they want referrals from the other dentists. So so just to give you a sense, in the first quarter, dental admissions for the industry was down 14%. But although Q&M don't give volumes, but we think they definitely get some market share in view of the improvement in revenues of around 7%. So we maintain our buy, no change in our target price. We think that we are estimating dental clinics to grow maybe around 20% this year and another 20% next year. So 40% over the next 2 years. They have a more aggressive target, maybe a bit more. They're expecting 30. We are looking at 27. Next slide. UG Healthcare. Next slide. So for UG, the earnings was as expected, is within expectations, although it fell 70%, but we already kind of factored that in, so it's more or less within our forecast. The volumes were flat, but glove selling prices fell year on year. But for us, although we seldom use quarter on quarter, but because we are tracking prices, and that will be reflected in gross margin. So you can see that quarter on quarter, at least the profit is stable. The second quarter versus the third quarter, that 0.0 thing in the table on the left. So in terms of the positive, there was stability better stability in margins and profit, like I just mentioned. The negative is just that they are going to start a new factory that is going to ramp up 1.2 billion to 4.6. But the timing is going to be an issue because not just them, I think not just glove, I think almost every manufacturer in Malaysia is facing ability to source workers. So they basically said that how fast they can start is basically how many foreign workers they can actually secure. Yeah. So in terms of the outlook, the Chinese glove manufacturers continue to disrupt, but their disruption is mainly on nitrile. So their prices is really low. It's like 18, 19. Even pre-pandemic, glove prices were only 22, 23. But for UG, because they have got a big distribution business, so what they're going to do is just take advantage of these prices and distribute and still earn margins almost equivalent to the whole, that 20 to 30%. So the second thing that they're going to do is to raise the latex. So latex, just as a reminder, no, there are two types of gloves. There's nitrile, which the Chinese, this is synthetic rubber, which is mainly used in developed countries like US and Germany and Europe. And this is where all the Chinese are disrupting. But for latex, which rely more on natural rubber, which is mainly in Malaysia and in Thailand, the prices there are holding up better. Ironically, they're selling a lot in China because actually latex glove is much more comfortable, but just in developed countries because of the protein allergy. So these are the two things that will help them keep their earnings stable, their distribution, and also latex prices, which is doing well in China, in emerging countries like China and Brazil. The major challenge for them will be cost pressure, because in Malaysia, across all manufacturers, the minimum wage has been increased to, I think, 1,005 ringgit. But this will cascade up, because whoever earning 1,008 won't be asking. Whoever is more senior will also asking for higher wage. So across the board, it will just cascade up. Like you probably have it here too, and there'll be increase in tariff. So for us, we just find the valuations attractive. It's trading below book. Almost 60% of the market cap is cash. Yeah, and we think there's stability creeping in for earnings. Next slide. Oh, okay, no more. Okay, last one. Okay, in terms of our tactical views, related to real estate agents, the new launch, that means private new property launch, in terms of the units sold, this is from URA, total number of units down 50%. Year to date up to April is also down around 50%. So this will be a big drag for the real estate agents for this year, because there's basically not many new launches happening. RMC demand is still there, but up 7% year on year. I guess if you want to know visitor arrivals in Singapore, it's up 10 times year on year, but it's only 10% of pre-pandemic. Okay, I won't run through too much, but for the US, I think there were, you're going to hear a lot, every other day there's a Fed official speaking, but for us, we focus more on those who are voting members. So the two key ones is that mentioned today was Charles Evans, not Chris, Charles Evans and Powell. So for Powell, he just said that price stability is unconditional. That means he needs inflation. We found the Charles Evans comments a bit more interesting, and I guess more important for us at least. What he's saying is that the Fed will want to raise rates until neutral. So there's no definitive answer what is neutral, but the current interest rates or Fed funds rate is 0.75. So most agree is around 2.25, 2.5. So we think that the Fed will just keep on raising rates up to at least these levels, 2.5. And then from there, what he mentioned is they can sit on it. That means they can actually keep these levels and not go to restricted. That means push above 2.5. So that could be one scenario where interest rates will move, which we'll discuss a bit later. But the other thing is just retail sales. I'm mindful of the time. So in terms of our tactical views, we just think that the bearish sentiment will persist until the Fed move interest rates close to almost about 2.5, which we think there's 3 more meetings, so you could roughly hit it by September or third quarter. So I think the way the market kind of treats any economic data can be like half full or negative. What we're trying to say is that if the economic data from US is good, then they will say Federal Reserve will raise interest rates more. If the economic data is bad, then they will just say that your recession is coming. So the sentiment is just so bearish until we see some visibility that there's no tail risk in interest rate cycle. That means the Fed won't raise until 3% or more. So until that happens, I think we are probably in a very bearish sentiment environment, I guess, or at least move sideways at best. So in terms of events happening, we will have the key one is the CPI, the PCE CPI. So this is the Fed's way of monitoring. So whenever the Fed say we have 2% inflation target, he's referring to PCE, not the one that will be the other urban CPI, which we have here. So that will be released, and hopefully no shockers there. And then on Friday we have Singtel. So in the meantime, we will have these events, ASL on Friday. Next slide. Okay, this one just to show you the retail sales. Although it is slower in the US, but it's still above their 4% pre-pandemic. The table on the left is just to show you that online sales in the US, because of the pandemic, you can see this spike to almost 40% growth, but right now it has come off. So we think it could be just a temporary bump because it grew so strongly during the pandemic. And right now in the US, brick and mortar sales is growing faster than online. And maybe that's why, maybe that's also a reason why some of the tech stocks was also being sold down. There's a bit of a hangover after the surge. You can see from the blue line, the surge in online sales in the US. Next slide. Okay, this is just out of interest. I mean, this one was just when the Sri Lankan default, we're just curious to see their balance sheet. So their reserves, I mean. So you can see from this chart, in terms of how much reserves, that means how much US dollar you have to pay off your debt, your total debt. So Sri Lanka had, this 2020, this is the latest data they have is only 10%. That means, what it means that if you owe 100 billion, you need, if you owe 1 billion, you need 100 million of US dollar to pay that off. So of course you got Argentina, Turkey. Again, this is just for interest. Yeah. Next slide. Okay, last one for Yoma. Yeah, that 434, sorry, is a typo. That's we don't have rated, so it's not a target price. It's just the last traded price, which I don't know. I think maybe 12 cents or something. So just to give you some of the comments that they made. In terms of the pandemic, the country Myanmar is. Sorry, for those who don't know, Yoma is the property developer, vehicle distributor. Totally, everything is all in Myanmar. So he said that the country that has reopened. The airport was closed for 2 years. In terms of the politics, there's a election next year, but it might still be difficult to reopen to the developed countries because they may not deem it as fair, because Aung San Suu Kyi is still, I guess, arrested. So it may not alleviate all the issues, even if election next year. In terms of the Ayala, so just as a refresh, Ayala is supposed to put in 2 rounds of placement. They put in the second round, but they converted it into a perpetual loan, which means it's more like a convertible. Eventually, it will be converted into shares. But they call it perpetual loan, I guess, because they can classify that as equity. They operate KFC stores. They close like 1/4 of it. Real estate is performing better. They're going to spend another 53 million to complete the purchase of Wave Money, which is their digital, their fintech arm. So in terms of the outlook, I just go straight to it. There is a recovery, but it will be gradual. I think so long as foreign investors don't come back in, it's going to be a slow recovery for the country, I guess. I think in the near term, the issue is going to be they need to deleverage their US 284 million debt. You can see the overhang it has. If you look at the table on the right, you can see that interest finance cost is 10 million every 6 months, and you can see that their gross profit is only 10 million. Less admin. So if you look at the cash flows, their operating cash flows is just enough to cover their interest expense. So they need to either improve their operating cash flow or of course do some asset sales. Otherwise, it's going to be a bit tight for them because of the interest expense, which is almost 20 million a year. And you can see from here, it's going to be hard to cover it. Okay, I think that's it for me. I think we can move on to Q&A.
Hi, I'll take the Q&A. Yeah, sorry, apologies for the typo. The target price on Microsoft should actually be $410 US, not 187. Thanks.
Natalie, you want to go first? Or Terence?
Okay,
Oh.
yeah, yeah. Okay, I'll answer the question on the yield spread. Average nominal yield spread between the 44 S-REITs and a 10-year bond yield is 4%. What is the expected nominal yield spread between Mapletree Industrial, Mapletree Logistics, Ascendas REIT, and the 10-year bond yield? So based on today's price and the consensus DPU, the DPU yield for Ascendas REIT is about 5.9%. So if you minus the 10-year bond yield is about 3.2%. Then for Mapletree Industrial, the dividend yield is about 5.6%. So that means it's about that means it's about 2.9%. And then for Mapletree Logistics, it's about 2.7% dividend yield spread. Yeah. So that means overall, right, amongst these three REITs, Ascendas REIT has the highest dividend yield spread because their dividend yield currently is the highest. And I think if you're concerned about, I mean, in terms of the dividend yield spread, I think it's attractive entry. And if you're worried about whether or not like this means that with this high dividend yield, does it mean that it's more difficult for Ascendas to acquire because of the higher required rate of return, cost of equity, etc.? Then I would say that given A-REIT's current gearing of about 37%, they still have a sizable debt headroom, about 4.6 billion to 50% gearing. But of course, no one's going to go to 50%. So even if we take half of that, 2.3 billion, that's still quite a lot of room to acquire just using debt alone. So I think that just means that they still can acquire quite creatively. And if you look at their most recent transaction, the US logistic assets that was acquired on the 10th of May, that was at a dividend yield, MPI yield of about 5.3%. So that just means that even if you were to take a higher cost of debt, there is still some yield. Still some positive carry for the acquisitions. Yeah. And of course, if you look at the A-REIT, Mapletree Industrial, Mapletree Logistics, in terms of size-wise and in terms of debt headroom, the larger you are as a REIT, the larger your debt headroom. I mean, for a comparative level of gearing. So that just means that A-REIT will have the largest debt headroom, followed by Mapletree Industrial, followed by Mapletree Logistics. And Mapletree Logistics is the one that is trading at the tightest, or rather the lowest dividend yield amongst these three names. Yeah. Sorry, let me just see. Okay, the other question here is what is meant by PE fund management transaction fee revenue? So okay, so for the fee revenue, there's some that is recurring. For example, just for the management of the REITs or management of the private equity fund, they'll probably take a percentage of the AUM that is being managed, or the FAUM, fund asset under management. So that's just for purely day-to-day kind of like management of the fund. And then, the transaction-driven revenues, for example, a lot of your PE funds, they will actually have fees tagged to, for example, a performance. If let's say they are able to exit they're able to exit the fund or liquidate the fund at the end of the holding period, let's say 5 years, then for example, if they were able to liquidate it at maybe profit of 20%, then that will of course, the higher the profit that you exit it, or the higher the IRR at which you exit, that will of course flow, be reflected as the management, be reflected as the performance or the promote fees. So those are the kind of transaction-driven revenue. Usually it's related to divestments or acquisitions. Yeah, and that's transaction. That means you cannot expect it to be recurring all the time. Or it's very event-driven, basically. Yeah. Okay. Another question is related to Ascendas, Mapletree, and Mapletree Industry, Mapletree Logistics. They have weak price actions in the past 2 weeks. Any assignable cause for this phenomenon? And given the hawkish stance of the Fed and the market adjusting to price in a 3% 10-year bond yield, I think overall, what we think is happening is it's just more of the recovery names dominating, and because of this whole hype with regard to new economy assets, the likes of your logistic, the likes of your data centers. So I think in general, these new economy kind of asset classes, the business parks, science parks, they tend to command. I think the competition for these assets are also have also heightened, resulting in tighter cap rates, or rather more expensive kind of valuations. So I guess that also impacts the growth potential or the inorganic growth potential of these REITs. So I think apart from the shift or the preference of the recovery names, this is also one additional thing weighing on the industrial names. Okay, I'll take the question about the Mapletree later on. Another question here is, with recession looming, what will be the add-on effects for the REITs and the opportunities that we can look out for? So I think in terms of headwinds, that is quite clear. The rising interest rate is a headwind. Also, of course, inflation is a headwind for the REITs. Some of them, they might not be able to pass on the inflationary costs, 100% of the inflationary costs. So that might also have some impact on margins. And I think just in general, the geopolitical environment, etc., this has resulted in a need to be more cautious when it comes to looking at acquisitions. The buffer when it comes to looking at acquisitions, in order to make it accretive, because interest rates could move within the next 12 months, that means that they need the managers need to price in a bit more buffer when it comes to valuing or evaluating these kind of potential acquisitions. So that might also slow down the inorganic growth potential of REITs. Yeah. So I think those are just the main kind of headwinds that the REITs are facing. Okay, I'll let the rest of my colleagues take some questions first before coming back.
Yeah, sure, Natalie. I'll just jump in to take the question. Do you prefer BRC over PenU? There are a few questions, so I'll just take maybe the first two first. What caused the 80% drop on operating cash flow for BRC? So I'll just take these two questions first. BRC is our preferred pick in the construction sector over PenU, mainly because BRC have a stronger market share in the sector, and then also their dividend yield is a little bit more attractive than PenU now. So they're trading about 10% for FY22. PenU is about 3 to 4%. So and we have a higher target price for BRC as well compared to PenU. As for the 80% drop in operating cash flow, that is the result of the increase in inventory that BRC Asia had for FY22. The reason why they had to increase the inventory increase was a combination of two factors. The first is they were fulfilling more orders. The second reason is because the cost of inventory has also gone up. That's why the operating cash flow came down. Is there a concern? Not really, because most of the reason for the fall in operating cash flow is really what BRC is trying to do is trying to build up inventory to fulfill the orders in the next few quarters. So they have no issue in terms of like what we mentioned in our slides earlier on. No visible issues with regards to debt collection from their customers as well. The government has also come in to support the industry through better credit management, sometimes paying the construction companies in advance. What they've also done is also HDB has also tried to keep a lid on the rising cost. So they buffer the rising cost of raw materials for the suppliers. So the government is providing support to the industry. Last question, what is its cost of debt and percentage hedge? So BRC's cost of debt about 1.5% to 2%. The reason why it's so low is because most of their the debt on their balance sheet, especially the short-term debt, is all trade receivables and receipts, trust receipts. So all of these are all financed by orders. They don't have any debt that is used to finance their operations. No, so it's all trust receipts and papers. So the cost of debt correspondingly is very low. Percentage hedge for the debt, they because it's trust receipts, they are not hedged. Yep, I think that's all for me. I'll hand the time back to the rest of my colleagues.
Okay. Probably I'd like to take one question, which is for the Astrea bonds, which bonds is more? Oh wait, hold on. In view of rising interest rate, are Astrea bonds still attractive? So in terms of rising interest rate, Astrea bonds have a step-up rate of 1%, and if they are not called on their mandatory call dates to remain competitive in the market. And secondly, these bonds are highly diversified, which is spread across like 982 investee companies and across different sectors. Hence, this diversity will definitely certainly lower the risk of the bond repayments. Yep.
I think I'll take some of the banking questions. I think I see a few of them. So I'll just give a brief views on the outlook for all three of the local banks. So I'll start with DBS. For DBS, we feel that the interest rates increase would be very beneficial to them, and they have also mentioned that they would, assuming rate hikes of 100 basis points, their NII could climb about 21%. So this will affect their baseline, their PATMI by 26% increase. One of the other points for DBS would be that they have guided for a benign provisioning cycle. So their credit cost is very low this year, and they are maintaining it to be stable at 12 basis points. So this is actually below the pre-pandemic credit cost. And our target price for DBS is $41.60. So for the second one, I'll move on to OCBC. So for OCBC, we feel that OCBC is our preferred pick amongst the three local banks, and this is mainly due to their attractive valuations as well as their upside in dividends. So they are from the 15% CET1 buffer. So their CET1 is the highest amongst the three local banks, and as well as lower provisioning as the Indonesian and Malaysian economies recover. So previously in the previous quarter, so for the fourth quarter 2021, they performed the worst amongst all the three local banks, and this was mainly due to increased allowances in Greater China, as well as higher NPLs in Malaysia and Indonesia. However, in the first quarter, they show improvement, as these economies are picking up, so they all the NPLs were stable or went down. So this sort of benefited them, and it performed quite well this quarter, first quarter. So for the NIMs, as the same, roughly the same story, as they would benefit from the increase in NIMs, in interest rates. So this would benefit their NIMs. And our target price for OCBC is $14.22. So for moving on to the last bank, and that would be UOB. So UOB for the excuse me. So for UOB, for the outlook, we also expect the improvement in the interest rates to impact their NIMs positively, and for their, if assuming again rate hikes totaling 100 basis points, the NII can climb by 11%, and this will affect their PATMI by 17% growth. So for UOB, their loan growth, they have guided for mid to high single digit, and they have mentioned that they would expect the ASEAN loan growth to be higher. However, with some slowdown in Singapore and North Asia. So this is because the growth has been skewed towards the developed markets, but their ASEAN economy remains muted. And they expect this to change moving further into the 2022. The target price for UOB is $35.70. I think also, so moving on, there's one more macro question. Hold on, let me try to find it. If the Fed increased their rates to the targeted level, what would that do to the SORA rate? So we are looking, if I recently had released the Banking Monthly. So Banking Monthly, this will show a chart of the Fed fund rates against the 3-month SIBOR as well as the 3-month SOR. So it's tracking, if you look historically for the past, let's say 7 years, right, for the chart, it tracks, it's quite correlated. So similar increases, yes, I would think that there will be similar increases as they are quite closely related. Let me see if I have any other questions. So impact on the local banks of interest rate rises and recession risk. So interest rates, I think I've mentioned that the banks will be quite beneficial as they all have this float. So they have like cash at hand, and this comes from their CASA. So CASA would be the current savings, and yeah, current savings. So this cash, right, they are just earning interest on it, and they give us the interest that they're giving out to their customers will be, I think the base is 0.05%. So if the interest rates increase, this is sort of like, I would say free money for them. So they can just keep earning from this. So DBS and OCBC currently have the largest CASA balances. So they would definitely be more beneficial to these two banks. For recession risk, with rising interest rates, there's also a chance of, there will be a chance of recession, but they don't foresee that happening. And their loans growth has been quite healthy so far, especially for the first quarter, it looks quite healthy. So they're all sort of guiding for mid to high single digit, all three banks. So for now, I don't think there's much recession risk. I think that's all I have for the banks. I'll now hand it over to the rest of my colleagues. Thanks.
Okay, I'll take the next question. For the Astro bonds, which bonds is more attractive, the SGD or the USD bonds?
Yeah, can someone flash the Astrea slide part? One more. Okay, yeah. And Sean, can you also explain what is interest rate step up?
Yeah, thanks. Sure. So in terms of attractiveness, right, it boils down to the risk appetite of the individual, as Class A1 SGD bonds are senior in rank in terms of the repayment as compared to Class B bonds. So next would be hold on.
By the way, senior in rank is a fancy way to just say you get paid first. Okay, if anything bad happens, you get paid first. So that's why they call it senior. Okay, I'll go ahead, Sean. Sorry to interrupt.
Next question will be, can you explain what's a mandatory call? So a mandatory call for Class A and 2 means that on the 5th year of the scheduled call date, the bond issuer will have to redeem back all the bonds that are issued for Class A1 and A2 if they have sufficient amount in their reserves. Yep. hope that explains what's a mandatory call. Then for this interest rate step up, it also links back to the mandatory call date. So like what I've mentioned earlier, for Class A1 and Class A2, there's a mandatory call date of 5 years. And if they do, and if Astrea 7 do not reclaim the Class A1 and A2, the interest rates for Class A1 and A2, as well as Class B, which is on the 6th year, will increase by 1% of their coupon rate. So you can look at it as A1 from the 6th year onwards. For A1, it will be 5.125, A2 will be 6.35, and Class B will be 7%. Yep, hope that's answer your question. I'd like to hand over the time to my colleagues.
Okay.
Sorry, Paul.
Yeah, go ahead.
I think I missed out one question for the banks. Let me just quickly cover this one. Where do you go? Okay. Would you factor in loan provisions risk for the banks if recession hits? So for the loan provisioning, that's a good question. I would say all the banks, they have, I mean, they were all sort of, I would say, caught off guard by COVID. So now they sort of know what to expect, and they have all set aside sufficient GP reserves above the required amounts and above what they expect. So they have been slowly writing back some GPs. I think DBS is the most aggressive, but UOB being the most prudent. OCBC is somewhere in the middle. So I think they have definitely set aside enough GP in case a recession hits. So I don't think that the loan provision risk is very high. So they are sort of prepared if anything bad would happen again. Yeah, hope that answers your questions. Answers your question. Thanks.
Yeah, I mean, just to get back on the question, a provisioning cycle for the banks, which is basically rising provisions, is something we are always monitoring. But I mean, if you take a step back, is there any risk of provisioning cycle in Singapore? Really not sure. Maybe 2 years ago, yeah, during the pandemic, you know, the hospitality and so forth, that was the weakest part of all the economics sectors. But right now, there is reopening, so I'm not sure if that is a soft spot. And then like the other countries in the region, like Indonesia, Malaysia, again, there's reopening and there's also commodity prices recovering. So we're not sure if that could, we can't see those provisioning cycle happening even in those countries. So it's a bit hard for us to, of course, maybe 2 years time, but in the next 12, 18 months, we don't really see any provisioning cycle happening, at least for the banks. Yeah. Okay, let me just quickly run through before I hand it over to Natalie. Your view on Cascadian mandatory offer for SPH REIT, where its offer price is 3.8% lower than the last trade. Yeah, I think SPH. Okay, firstly, Cascadian. For those who do not know, so when Cascadian offered to buy SPH, and then SPH owns the REIT. So they had to make a chain offer, not that they like to, but they just had to. And then it was based on the volume weighted price when they made the offer for SPH. So the price is 93.7 after the dividends. So I think SPH REIT will probably just going to trade, and I think Cascadian has no plans to delist SPH REIT. After all, it's a REIT, right? So I mean, no purpose to have a delisted REIT. So I think this stock will just trade. After when the offer is over, you will just be trading around, and then it will just be back to how people view SPH REIT's performance. Why is trading? It's pretty small. I wouldn't say it's that huge. I'm not sure it's 3.8% because the offer price is not 96. The offer price is 93.7 because you got to deduct the 2 dividends. I think maybe that's how you got the 96. Yeah. And I initially thought that those who got the SPH, those SPH shareholders that opted for the SPH REIT shares would dump, but they didn't receive their shares 12 May. So if they wanted to sell, they were already sold. So I think SPH REIT will just trade along like any other REIT, and people will just look at it because it's already at the offer price. So those who want to keep it will just hang on to it and will continue to be listed and just trade along like it used to before the offer, I guess. Yeah. How about if you have the bearish sentiment, what is your advice for retail investors? What strategy? I think actually in the near term, I think the market is already pricing in a lot of interest rates, and I think the market is a bit dialing back on interest rate expectations. So I think in a medium term, I think the REITs might perform well because people are starting to fear there is a sharper than expected slowdown. And that could, in a way, be positive for some of the REITs. That means interest rates, the highs of interest rates might have already been capped if you look at the 10-year bond yields. Yeah. We don't think, again, so far, we don't see any of the indicators pointing to recession. Maybe there's an asset recession, I mean, because something like the dot-com bust in year 2000, when a lot of the asset prices fell, but although there was a technical recession, it was very shallow in the US. I think minus 0.1 or 0.2% only. So it might, again, I mean, there's no very high visibility of it, but it could be like a year 2000 type of, the asset prices collapse, economic conditions weaken, but only modestly. I mean, that's a base case scenario for us. Okay, I'll take one. SIA April 22 operating results show the passenger load factor has recovered to 70. How do you interpret this number? Load factor is, I don't know why they like to call it load, but it's basically capacity utilization. So it's like how many passengers on the plane. So 70% means it's 70% full in the aeroplane. Some of the things analysts typically ask, I wasn't in the call because they don't allow me in, but they will look at what is the break-even load factor. I didn't see them mentioning. And pre-pandemic, the load factor was around almost 90%. So I mean, one way you can play this stock, I guess, is if you want to play on just news flow, is when they hit 90%, of course, you better start running because they probably hit the max in load factor. So probably one way to trade it, I guess, is if their load factors already hit 90, which is really as good as you can. I mean, it's like 90, right? It's almost full. So there's still upside to their load factors. I don't know, that could be one way to play the stock. I mean, just on news flow and improving conditions. But load factor is just utilization rate, just another fancy term. Phyllis maintain buy for Comfort. What is your view on SBS? SCS highest dividend? Yeah. SBS is basically Comfort without the taxi. Yeah. So just that SBS has very thin volumes. In a way, SBS could be a better proxy to the transportation because you don't have to worry about taxi and so forth. But the main reason most analysts cover Comfort is because the volume is much higher. There's hardly any volume. But you're right. I mean, if the dividends are better and it's a much more stable because your SBS Transit is mainly bus, which is almost recurrent stable income, and rail, which it will recover. I think as the reopening, the real numbers. So it is also another good way to play the recovery in transportation. Okay. Okay. Olam price has fallen a lot. Is it time to buy since the commodity price is still bullish? Yeah, I think one way to interpret it is it has fallen because there is this whole restructuring that they want to do in London. So I mean, if the markets are weak, then maybe any listing that they wish to do would be delayed. Are they a proxy for commodity price? I'm not too sure for that because they are more into trading. It's not very clear that higher prices can benefit them. It's not like a plantation. So if you want to buy commodity, then it's more just the plantation stocks and coal stocks. But I wouldn't be betting on them just purely because prices are up. It's more the whole restructuring story. Yeah. Because it's not very clear that higher commodity price is like it's a 1-for-1 benefit. Yeah. Of course, it shows demand is strong, but when we look at their numbers, sometimes it's very hard to kind of to do that correlation between high price means higher trading income for them. Yeah. How can I watch the replay of the US equities webinar, and when is it loaded? John, I think, not sure if you can. Yeah. what's happening to Olam? Why is the price taking such a hit? I think it's mainly because with the weak stock markets, I think any plans to kind of list their operating unit in London, I guess, can only be deferred. What's your view on Sheng Siong? We still like Sheng Siong, but this year will be a year consolidation because after the bumper, the last 2 years has been record earnings. We still think it will the earnings, our estimates is maybe drop mid-teens. But their market share, the main story for them, I mean, apart from people spending more time grocery shopping, is because they're taking share from the wet markets. That's why you can see their fresh food continue to do well, and that's the best margins. And fresh food is not as easy as it seems. If you ask anyone who operates it, there's a lot of wastage, a lot of spot goods. So you need a very good process, which Sheng Siong, somehow managed to get that process right. The second thing is new stores. So new stores will only start to contribute second half. And then, so you can think of this store as very stable and it will just earn, it will probably grow, high single digit type of growth. Yeah. Just that this year, because last 2 years have been so good, when the borders reopen, you can only expect slower grocery shopping. And more because people won't be dining so much at home. Okay, I'll hand it over to you, Natalie.
Thanks, Paul. Okay, some questions here regarding Mapletree Commercial Trust and Mapletree North Asia Commercial Trust. Okay, so the first question, is the merger approved? So I think it hasn't been announced yet. Today, the 23rd of May is when they are holding their EGM. So actually, Mapletree Commercial Trust, MCT, just had their EGM at 10 a.m. And then MNEC will have their EGM at 2:30. So by the end of today, we should know what is the outcome of this merger exercise. Second of all, the question here is, which scheme of consideration is better for the shareholder? I think the answer really depends on whether or not you continue to believe and want to stay invested in this new vehicle, which is MPAC. So of course, if not, then you can take a riskless exit and just take the cash consideration of 1.19. Otherwise, for those MNEC unit holders who wish to roll over into Mapletree Commercial Trust, then you probably can benefit from the recovery of course the portfolio, consisting of VivoCity as well as the Mapletree Commercial, the business parks, and the overseas assets, which also continue to recover from the pandemic. Yeah, I guess that is one way of looking at it. But of course, if you are not confident or you're not comfortable with having a portfolio that is, that has assets located overseas, then of course, I think the very obvious answer would be to exit lah. Yeah, so I think in terms of the consideration, it really hinges on your comfort level of whether or not you want to stay invested. Yeah. And of course, another question here is whether or not it's positive for MNEC. I would say that overall it does look positive for MNEC, because as a Singapore REIT, although investors do like 100% focus on Singapore assets, which are very visible to the local investors, and we can observe how they're performing, compared to, of course, having assets in a foreign country where we may not be so familiar with the politics and how the assets are performing. The Singapore assets will definitely have a lower risk, but I think the question here, of course, would be growth potential, because in Singapore, I think there are limited, there's limited transactions, limited area of growth for as in just to acquire Singapore assets. So looking overseas, as many Singapore REITs have done, in the last few years, will of course be another runway of growth for MCT. And I think that if they want to continue to grow and enjoy the growth as seen by other S-REITs, then going overseas is inevitable. Yeah, so I think overall, acquiring MNEC would give them this ability to tap onto the other Southeast Asian kind of countries and the growth of Southeast Asian countries, as well as because MNEC already does have teams in place and a platform in place, so that will definitely help. Acquiring MNEC also means that they are acquiring MNEC's ROFRs, which also, of course, is a potential for growth for MCT. I mean, in the mid to long term. Yeah. I hope that answers the question. I think that's all for me.
Yes. I think the question on the US equities webinar, I believe most of it, all our webinars are uploaded to the PhillipCapital YouTube website. I can drop the link in the chat. You can go and check it out. But for the most part, every quarter we'll have our strategy and stock pick, usually by the first or second week of by the end of the quarter. Thanks.
Okay, thanks. Let me just try to wrap it up. What's your view on Yang Zhejiang Financial Holdings? It's trading more than, yeah, I think this stock looks interesting at these levels. Yang Zhejiang Financial Holding, mainly for, of course, it's 0.5 times book, so that is cheap, and also because although they don't disclose, the problem is their disclosure, but if their type of loans isn't so long, this company could be a very high net cash company at these levels. They could be trading at cash, because if you assume their loans are 1 or 2 year loans, if they convert most of it back to cash, that means they don't want to lend out, and just to show the market that there's a lot of cash on the balance sheet, it looks attractive at these levels. And if they want to pursue share buybacks, the problem is that they never really gave a full disclosure of what is inside their books. But if you think of the way they lend, they're not like although the Chinese banks or any typical bank will have a long duration type of loans, maybe 3 to 5 years, theirs could be quite short. So at this level, I think it is interesting. The reason why it's sold down, because the 2 rounds of selling are because of the CPF selling. We're not eligible for CPF initially, I think it is now. And the second round is because they got kicked out of STI. It's like, obviously they kind of dropped the ball, I guess. Yeah. But these levels, I think, is interesting, yeah, for this stock, because there could be a lot of cash inside this company if they choose not to redeem their loans, just to show the market. Yeah. Okay. I think the next, a lot of it could be US, but these are technical. Any views on holding Sheng Siong and Olam in inflationary environment? I think for Sheng Siong, I can't comment on Olam. Olam should also do better, because if they are trading commodities where the prices are higher, theoretically their margins should be better. Yeah, because if they're doing it percentage, again, this is it also depends on competitive environment. But they should they should be able to hold out in the inflation environment, which is higher commodity prices. For Sheng Siong, again, they will also pass on their higher price. But the reason why it's hard for me to answer, because it all depends on the competitive environment. If Sheng Siong tries to pass it on, but NTUC decides not to, then it's going to be very challenging. But Sheng Siong's edge is in fresh food, where they have because of their volume, they have a cheaper cost than some of these wet markets. Okay, I'm just trying to. What are your views on Yang Zhejiang? Okay, we answered that. Is the debt load for Olam too high for comfort in this rising environment? I think it's reasonable, because most of these trading companies, they rely on a lot of, like any distributor and trading company, you are essentially giving credit. So that is your model. And don't forget who is their parent, which is Temasek. So Temasek was willing to do a general offer for them. I think at 2 something. Yeah. So I'm not sure. Yeah. So I'm sure they'll be more than willing to. I think it makes a lot of difference if Temasek as a parent. Yeah. Yeah, but I don't have sensitivity, sorry, because I don't really cover the stock. Yeah. Okay, then okay, let me answer this before I hand it to John. NVIDIA, Modena needs support and resistance. Sorry, we don't have technical. So our technical is done, I think, 8 p.m., not now. John, you want to take this last one?
Yeah, Paul. So I'm not exactly too sure about this last question. It says
I
Apple,
think maybe
Microsoft.
what you're trying to say is there upside to the estimates? Is there upside to earnings? I'm assuming.
Right. So for Apple, I think that there are quite a bit of headwinds for them in the short and medium term, mainly due to supply chain constraints, and also over the last couple of years, a lot of people have been buying a lot of products. They've been upgrading, and I guess mainly because of COVID, they've got nowhere else to spend their money, maybe. But as we begin to reopen, and most of the world has been reopened for the last few months or almost a year, you probably see a bit of spending moving away from products and into services like your travel services, especially. So it could be a bit more of a headwind kind of environment for Apple. But for Microsoft, it's most of their revenue comes from like corporate demand, and I guess they are a software service provider, and so it will be the kind of the opposite from Apple, where corporate demand is quite strong. Their licenses they can essentially increase the prices of their licenses, and people or companies will still be willing to buy it. At the same time, there's not really much option for a lot of corporations. If you don't use Microsoft software, what else are you going to use? There's really only Excel and maybe like Google Sheets. So a lot of upside for Microsoft, and that's kind of why Microsoft is one of our top picks for the thing. Yeah, thank you.
Sorry, just want to jump in real quick here. Just now the question was which option to choose. Number one, the scrip only. Number two, scrip and cash, or number three, cash only. I would say the third option would be the best, given that the exchange ratio for which the option one and option two, which has the scrip component, was actually fixed based on the MCT's price of $2, and of course now MCT's price is 1.8. So I think you're better off just taking the all cash option